Happy Friday, everyone. Dan Bird here with the Daily Scan for March 28th. And the week is over. The month is nearly over. Not quite. One more day left on Monday. But as you can see, a very angry PCE pushed the market, Mr. Market, over the cliff. And Monday, if that continues going down, then the picture will be Mr. Market falling from the cliff. But he actually pretty much fell today. So we'll take a look at that, see what kind of damage was done, and whether or not there is a bottom in sight. So stay tuned. We'll find out. I hope everybody is safe and have been heeding my warnings over the last few weeks that this was likely coming, and it may not be over yet. It may be quite a bit more down, perhaps left to go. So as always, I am not a financial advisor. So I cannot give you advice on what to buy or sell or how to buy or sell it. It's up to you. You have to do your own due diligence and take responsibility for your own trades. Nobody knows what the market is going to do, including me. So let's take a look at what happened today. And we get a lot of weekly updates that I'll show you as well. So the market bias, sharp turn down again. So it's hitting right down near where the lows were. Hasn't really broken below those yet, but getting pretty close and wasn't looking too good either. So let's take a look at the S&P. I mentioned this last night on the S&P that I put down here the weekly Bollinger Band. You see the dotted line? And we went right to it today. So what I said yesterday was the weekly Bollinger Band and the 2X Keltner channel are in almost exactly the same place. So that's an area that might provide support. Doesn't mean it will. If it did next week and we started to go back up, then that would create a higher low. However, we could also come down here to the 3X and even go through to the 4X, which we haven't done that. A little bit right in here, just intraday. But usually intraday, when we get into that area, the 4X area, outside of this red line, then it doesn't stay there very long and it usually reverts to the mean, which is exactly what it did back here. Went right back to the mean, hit this resistance line, which used to be support, and got rejected, started heading lower. So that's where we are. Really important level. The market may continue going down from here next week. That would not surprise me. We shall see. There's the NASDAQ 100, same place, made it right back to the same place. Ugly looking candle today, and it closed at the low. So could have kept going if the market had stayed open, but it stopped going down because the market closed. So that's the NASDAQ 100, not looking great. The Russell 2000 actually didn't quite make it down there. So it might have more to go, unfortunately. So that's where the other supports are. So that one might head there as well. So, and you can see all the ADX lines are heading higher and starting to go above 25. So everything is looking very negative. Bitcoin today, be interesting to see. Yeah, MicroStrategy down here. See, it's got a red candle now. It's below the 21. So it's moving lower. There's Bitcoin, got rejected off of this very solid downtrend line, continually gets rejected off of that line. And it did again today. So Bitcoin, it looks to me like it probably is going to go down here to that same support level down in this area. So it's got a pretty huge daily squeeze, but it may actually looks like it's going to fire to the downside now. So keep an eye on that. Not looking good. None of this looks good today. Let's take a look at the market bias matrix, and I'll show you some of the updates that I do for the week. Usually do on Friday. Notice all the red squares in here. So lots of red. Utilities got a short-term bullish signal, but lots of red squares in here. A couple of green ones. This is cotton, had a short-term up. And the yield curve, interestingly, had a medium-term up signal today. But you see Bitcoin has the short-term down, and the 10-year Treasury also went down today. You can look at that. Here's the 10-year yield. You can see that's rolling over and heading back down again. Now it's back to 4.25, back where I said it was going to be. So 4.25 is probably the level that it will revolve around or consolidate in around this level right here. And we're right back to it again today, just as I've been saying for a while. So you can see lots of red. The color chart up here, it's got 2 yellows and 2 reds now. We're trying to get some greens, but it's rolled over now quite a bit. In fact, if it goes much lower, I'm going to have to lower my grid. You know, I had to move it down. I had it at 45% up here, and I had to move it down to 35% this last time. And now I might have to move it down again, maybe to 25%. But everything is definitely rolling over. Does not look good. A lot of the long-term ones haven't really started to move yet, though. Some of them are red, but there's still quite a few greens in the long term. And that's when the market is really basically in a very long-term downtrend, when those start to turn red. That might take a while. If we look at the S&P, for that to turn red, we need this 50-day line to get down here to the 200-day line. That's quite a ways to go. But take a look what happened today. I'll show you a couple of these. Look at that big red candle today. That's the S&P 500. There's the NASDAQ composite sitting right on support. There's the Dow. There's the NASDAQ 100. Here's the S&P 100, mid caps, small caps, New York Stock Exchange, Russell 2000, growth, value, even value got hit today, transportation. Utilities is the only one that went up, the only one. Then if we look at the sectors, you can see here, the technology sector actually one more day and it will get a long-term down signal. So it's actually below the support lines for technology. Communication services, big red candle. Discretionary. So consumers had a little run where they bought some TVs and now they're not buying anything again, or they're buying staples, which we'll look at next. They're staples. Staples actually pulled back, but it's looking much better than discretionary. But looks like consumers are pulling back from everything right now. And utilities hanging in there, healthcare moving down a little bit, energy moving down slightly, materials, big red candle, so it's down today. Industrials gave a short-term down signal today. Financials, probably one day away from a short-term down. Real estate gave a medium-term down. So all of these are not looking good. There's retail heading lower as well. So everything is rolling over, not looking good. So let's take a look at some of the updates that I made. If we go to the charts page, this is for those that are subscribers. And the index button down here on the charts page shows the 5-year John Carter monthly index squeeze that I talked about before. John Carter showed me this when I met him at the Money Show back in November. And at that time in November, there were no dark blue bars here. But he was pointing at 2022 when we had a cyclical bear market where there were 2 blue bars in a row. This was November and December, even as the market was making all-time highs. And this is November when he first showed this. And he said, this is what I'm looking for to see if this happens again. And sure enough, December, we made all-time highs. January, we made all-time highs. And we get 2 blue bars. That means momentum is declining even as the price goes up. And then February, dark blue, and now look at March. We've got 1 day left, but I don't expect this to go all the way back up and make a light blue. I expect that to stay dark blue, and probably we're going to end up looking like this one over here. So keep that in mind. This is a very long-term downtrend. We will get rallies in the middle of it, so be careful with the rallies. And, you know, I wouldn't be surprised if we get one next week because we sold off a lot today. This is a monthly chart, remember, and if you look at the ADX that I've now added to it, you can see the red. So think of these as the bears and the green as the bulls for a full month. And you can see for the last couple of months, since the beginning of the year, basically, the bulls have been declining and the bears have been getting stronger. So the bulls are getting weaker, the bears are getting stronger. So that's not a good sign as well. Also, I put in last week's number for this blue bar. Last week was 89.5 and today it's basically 88. So shows that it's definitely been declining. This is updated as of today. Right below it are these are the index charts based on relative strength. And the strongest one is in the upper left and the weakest one is in the lower right. So NASDAQ 100 is the weakest of them. Russell 2000 and S&P are the bottom three. And gold is the strongest. Clearly, you can see gold keeps going up. Bitcoin, second strongest, and then the Dow. So you can see what these are looking like. Notice this histogram rolling over here on all of these. Keep that in mind. I'm going to show you that here in 1 minute. It's something that I've added here and I've actually just started looking at. So that is the index charts. We also can look at the aggressive sectors, and we'll see here they kind of look the same. Financials is the strongest and technology is the weakest. Technology has a red bar, so does discretionary and communication services. These are the three aggressive sectors, three most aggressive sectors, and they are all at the bottom. And then if we look at the defensive sectors are looking much better. Energy is number one, the upper left, and materials is the worst, the weakest, down here in the lower right. So staples and utilities, the two most defensive areas, are two of the strongest ones. And then we've got real estate and healthcare down here. All right, let me show you something that I just added here on the portfolios page for the MTS. And notice that the MTS now has a short signal. So what does that mean? That this is the trigger, the VTI, the total market index is the trigger that assigns these things up here. And the total market index is made up of all of these things: the Dow, the NASDAQ, the S&P, the Russell, and 3,800 other stocks. It has been bearish for a while. We got out of the long position, and I should put it's actually up 34% since 11.3. I'll put that number in there next time I do this. But we are now short. So what does that mean? That means you decide how you want to short, if you want to even short. If you want to use inverse ETFs, you could use the 1x, which is unleveraged, 2x leverage, or 3x leverage for the S&P, NASDAQ, and the Russell 2000. And if you want to see how they look on a relative basis to each other, if I want to look at, for instance, the NASDAQ here, so the 3x long versus the 3x short, you can see they crossed over back here. So this means the long is underperforming the short. If this is going down, it started to make a turn back up, and then it rolled over again. And I said at the time, we actually made money from here to here using the 3x short version. And then we actually lost a little. We lost 1% trying to go long right here, which I was a little reluctant to do that anyway, because I was expecting the market to go up and then roll over, which is what it did. So now, do we get into the short side, the 3x? You could do this with the 1x or the 2x. This is just looking at the 3x. They all should look identical. So if we look at the 1x, that's what that looks like right there. And 2x looks exactly the same. And the 3x also looks exactly the same. So they all will look the same. It's just the amount of leverage that you want to use. And if you always use a 7% stop, then you're only going to lose 7%, regardless of whether you use the 1, 2, or 3x. You could potentially get stopped out earlier on the 3x, but you're only going to lose 7% if that's what your stop loss is. So that's where we are. You can see where it went above the 21 right here 2 days ago, but it was a blue bar. Yesterday was a green bar. So yesterday might have been a good time actually to get in. It was certainly a great time to get in. And today it is a much bigger green bar. So let me show you something I've added here, and that's up here for the total market index. I've now added a monthly chart, and I think this will be very enlightening for everyone. If we look at the monthly chart, and I put these arrows here where the histogram, and this goes back 10 years. So this is a monthly chart going back 10 years. And I put the down arrows where the histogram cross over the 0 line for the first time. Now remember, each one of these is 1 month. So it could happen anytime in that month, but it has to stay below it until the end of the month. And if you just use that as your signal to go short, you can see where it would have put you short of the market. So in this particular case, this would have been January of 22, just before the cyclical bear market in 22. This one right here would have been January of 2020, basically just before COVID started. So you would have missed all of this down here. And this one back here is the 2018 trade war. Same thing, went below it right there. So 1, 2, 3, and now we've got it again. Now the month is not over. So, but theoretically, we could have such a big rally next week that this goes back above the 0 line. I don't think that's going to happen, but we'll see. It could. Notice how this is a MACD basically. MACD is rolling over at the top, crossing at the top. Same thing with all of these. So they're all in pretty much the same place. So that's what's happening right now. So this, I think, is a pretty strong signal to go short, even though we could get a rally. So what do you do in that case? Well, you don't go all in, first of all. You go in with just a portion of your position, whatever that position might be. And I covered position sizing a couple of weeks ago in a Technical Tuesday, or could have been this week even. No, it was last week. Last week's Technical Tuesday. So you can go look at that in the playlist. There's a playlist for Technical Tuesdays. But I covered position sizing. So what you can do is go partial position on this right now, maybe even a third of a position right now, and see if there is a rally. If there is a rally next week, you have an opportunity to add a little bit more. Because as you can see, this has been a pretty reliable signal. So if we miss it, in this case, on this month is almost over, one more day. If we were to miss it on this month, you can see right here, this is 22, this is 25. So that was 3 years before this happened again. If we go back to this one, this was January of 20 to January of 22. That was 2 years until that signal happened again. So you can all make your own decisions and do what you think is best. But for this kind of opportunity on the downside to make money on the downside, may not come back again for another 2 or 3 years. So we shall see. I mean, sure, the market can do anything it wants. They could end the war in Ukraine on Monday and the market takes off and this goes back above. That absolutely could happen. That's why you should hedge your bets with a smaller position size. And then as it confirms, or if it rallies back up slightly and then starts to roll over again, then add a little bit more. But that's what I would do. So that's something that I've added here. Something else that I updated on the homepage, and this is always here, this gets updated every week, is the secular bull and bear markets. So you can see this goes back to 1980. The green are the secular bulls, the red are the secular bears. Secular bulls typically last 18 to 20 years, and we have officially been in this one since 2013. Some people will say 2009 because that was the bottom. You certainly could start counting it from there, but you don't know for sure that it actually has ended until it breaks these two highs. So back in 2007, you could have said, well, or back here in 2002, 2003, you could have said, well, that's the low and we're starting a new secular bull. Well, no, that's not true because we couldn't get above this previous high. So essentially think of it this way. If you had bought something right here and held it for this whole period, basically back here in 2000, it would have been 12 or 13 years before you broke even again. So that's the way to think of these secular bear markets. So officially it ends in 2013. It should run to sometime between 2029 and 2033. Nobody knows for sure. But one way to tell if the secular bull is ending is by look at this chart every once in a while on the homepage and see if any of these are getting ready to cross. Now you can see we do have a bearish divergence up here on the relative strength index. And we also have one on the MACD. This is a monthly chart, so it's very long range. Takes a long time to move. The relative strength is moving down, but it did in 22 as well. It did in 2018. It did way back here, but it never went below the 40 line. So that's what we're watching for. It needs to go below this line to determine that we may be ending the secular bull market. The MACD, same thing, needs to go below the 0 line, which it did back here and went back above it here, went above it here as well, but we were still in a secular bear because we hadn't broken the top yet. All right, so this has not gone below the 0 line either, even though the histogram is just beginning to. You can see over here, maybe even by Monday that might be. And down here, we need to break the 200-week moving average. Even during COVID, even though we traded below it, we never closed below it. Even back here in the 1987 crash, which was brutal in the markets for anybody, still did not break the secular bull market. Went down and touched that line, touched it again over here in 1990 with the Gulf War, and the market sold off there, but never broke that line. Not until here in 2001 did it break through. So that's the other one that we're watching. None of those have triggered yet. So I would suggest that if you just want to know where we're at, come back and look at this. It clearly looks like we're heading down, much like we did in 22. So we could get back to that line down here, but we're not there yet. Okay, let's see. What else did we update on the market bias page? Let me make this a little bit smaller. By the way, you see how this goes off the edge? I've had some subscribers that come to the website say I can't see everything. Well, all I'm doing is I have an IBM. I'm doing a control minus sign. Makes it smaller. I can do it again and makes it even more. For those that have Apples, it's command minus or command plus to make it smaller or bigger. All right, so down here we have the year-to-date large cap gainers and losers, and we'll just take a look at some of the names. SMCI is number 2. Newmont Mining, a gold company. You can see the industry groups and the sectors over here as well. Uber is up there. GE, Aerospace, Amgen, Intel, it's in the top 20. Palantir, AbbVie, these are all in the top 20 year to date. The bottom 20, Trade Desk, has just really been killed this year, down 52%. This is year to date. Decker's Tesla is on here. I'll show you something about Tesla here in a minute as well. Marvell, semiconductors. You can see all the semiconductors on here. Hewlett Packard, Arista Networks, airlines, Target. Those are all on the bottom large caps, and the mid and small caps over here. I'll just see if there's any names that jump out. HIMS, we talked about before. It's in the top 20. A number of these have been acquired, like Triumph, it's acquired. SolarWinds was acquired. I think I'm not sure about TG, but some of these other ones have been acquired and they're still on the list. Solar Edge and Celsius, look at that. They're in the top 20 year-to-date gainers for small and mid caps. So that's interesting. On the losers, let's see if there's anything. Elf is on there. There's Abercrombie and Fitch, Tandem, Kohl's, some retail names. So that's it for the top 20. So these are on here. These get updated at the end of the week, but they have been updated now. So if you're just interested to see which names are out there, that would be a way to take a look at it. All right. The last thing that I will show before I look at a couple of scans is on the homepage. Let's look at the Dow theory. Again, I'm going to go through all of these tonight. So this is available to anybody. This is the old Dow theory, industrials versus transports. Look at the big red candles again. So this is industrials over here. You can see they made new highs. The vertical lines are the same date. So it made new highs on the industrials, but made new lows on the transports. That is non-confirming and implies the market is getting ready to roll over, which is right exactly what it did right there. So that's the old Dow theory. Now let's look at the new Dow theory. We'll start with NASDAQ equal weighted and S&P equal weighted. Same thing during these two time frames. It made new highs. Over here, it made new lows. And today, the equal weight S&P actually is much higher above its low than the NASDAQ 100 is. So NASDAQ 100, I think, is the weaker one, looking at this. NASDAQ 100 versus semiconductors. This is the cap-weighted NASDAQ 100. And again, look at the big red candle sitting right on support, as is semiconductors. So semiconductors usually leads, and it's leading to the downside. So that looks like there's more pain ahead for the market. And then finally, XLC is communication services. Again, you can see back here the two lines that are the same. When it made new highs, it made new lows over here. And today, communication services, big red candle, and the internet group, which is Google and Netflix and companies like that, it's actually at new lows now. So all of these are confirming that the market is continuing to go lower. We had a little bit of a rally. I thought it would be a little more than that, but we didn't get much. So now it's heading lower. It will rally again. So expect that to happen at some point. But I probably think that the rally next time will be lower than these lows. So somewhere lower than this. So we shall see. All right, let's take a look at some scans real quick. So this is happened to be on Micron right here. So Micron continued to go down today, heading down to those lows where it always seems to want to go. So it's continuing to head lower. All right, let's do a I'm going to try a bearish candle reversal scan. Let's see what we get. All right, Home Depot. Oh, we got Tesla on there. Home Depot. So this scan is looking for a engulfing candle, looking for after an uptrend or a rally, looking for an engulfing candle or a shooting star. In this case, it actually has both. So Home Depot this is on the daily over here. The weekly is the right-hand side. So on the weekly, it looks like it was trying to make a recovery, but I think it looks like it's going to fail right now. It's actually underperforming the S&P, even though it's outperforming its own industry group. Honeywell. There's an engulfing candle right there. It's in a squeeze, so it looks like it's firing to the downside. Definitely underperforming its peers and the S&P. This one over here is the sector versus the S&P. So the sector is slightly outperforming the S&P. The weekly is trending higher, but these all look like they're starting to move lower. So Tesla, let's take a look at Tesla and see what it looks like. It has let me expand the weekly. It has a shooting star candle over here. So this is interesting because remember last week when I did an option, I sold a put on Tesla on Friday, mostly because of this is a weekly, so these are Friday. This is each week. So this is last Friday. There were two hammers in a row. That's why I did it, and it went up on Monday, and I got out and made 90% on Monday. So that was a very quick trade. Ever since then, it's just come down since that time. It now has a spinning top, and it's now below the 50-day, right above the 200. So let's look at the daily. All right, so here's the daily. Um, so right back here actually is where I did the option, and I got out of the option here. And now we've got a shooting star yesterday, and it confirmed today, continuing to head lower. So I have actually done um, a credit spread, a bearish call credit spread on Tesla expiring next Friday. And my strike price is 285. So right there, you can see where that line is, basically right where the 200-day moving average is. So as long as it stays below 285 by next Friday, then I will make 100% on that. Doesn't mean I'll hold it to make the 100% unless it's really showing that it's going to stay down there. But if I get to 70%, I might just get out then, take a 70% profit, in less than a week, and that would be a good trade. So I'm just sprinkling in a little bit of option conversation here for those that like to do options. This is something that I just did, and you can use these scans this way to play bearish or bullish option spreads. In fact, on the website, on the options page, at the bottom, I have the cash settled options, which you get paid 60% long-term capital gains, regardless of how long you hold it. You can hold it for 1 day, and you still pay 60% of that is long-term. So this is something the IRS allows you to do. So these are all the cash settled options down here. You can see how bearish it looks, but these are updated every day, so you can see what they look like. But also in here are vertical spread strategies that will help you understand how to do vertical spreads. Vertical spreads are credit spreads and debit spreads. And if you're confused at which one to use, whether they should be bullish or bearish, and how to put them together for a bullish or bearish spread, a credit spread simply means that you get paid the money right away, just like I explained with selling puts. It's like you're the insurance company. So if you do a credit spread, you get paid money. If you do a debit spread, you pay the money, but it's usually less risk, usually with debit credit spreads. I am not going to click on this because this is for subscribers, but this is a pretty cool little visual that helps you understand how to do vertical spreads, credit spreads, and debit spreads. If I were to click on it, then anyone could do a screenshot and have it for themselves. So I'm not going to do that. This is a great book too, by the way, Mean Reversion Trading. I also have in here all the stocks that have weekly options. It's a CSV file that you can download into your own platform. And I included some of the weekly option scans that I run, and in particular, my favorite ones that are at the end of this. And you can just copy, if you have a stock charts account, you can copy and paste them right into stock charts and use them for yourself. All right, so since today is Friday, let me try some weekly scans to end this for today. Let's look at the 8 crossing the 21. No, let's look at the 21 crossing the 8 weekly. So this is looking at the 8 crossing from the top to the bottom. All right, that's why it's reversed right there. So it's coming down from the top. So it was in a bullish configuration. Now it is in a bearish configuration on a weekly basis. So I'm going to run that scan. Let me make this a little smaller. And let's see what we have. Citigroup is on here. So this is the weekly over here. If you focus on this one over here, you'll see on the weekly what it looks like. So you see the pink line is the 8 and the blue line is the 21. So remember I said it's the 21, 8 crossing the 21 from above. And the way that this is designed, it's looking for something that's closing below the 21 and just getting ready to cross. So this pink line probably won't actually cross until next week, but it gives you a little bit of a head start if you want to short some of these stocks, or if you want to do bearish credit spreads, just like I explained on this one. So you could do it from right here. You could do a credit spread at $74 or $75. As long as it doesn't go back above 75, then you'll make money. Capital One is right here. Here's CrowdStrike. That has 2 shooting star candles in a row on CrowdStrike. And take a look over here at the daily. It's bouncing off the 50-day. It's right in the middle of its range, so it potentially could get all the way down here to the 320 area. So it gives you kind of a target to shoot for. Here's DocuSign. This is an engulfing candle. So again, that is a very bearish candle. This is on the weekly over here. We've got a couple of financials in here, and they're going to start reporting week after next. So this may be the clue, the key to what happens into April. And you can see a bearish engulfing candle on that one. It has crossed over on the squeeze down here as well. JP Morgan, that's got a shooting star candle this week. So remember, this is weekly. So since today's Friday, this is complete. This candle is complete. So that's a shooting star, and it's getting ready to cross down here. Eli Lilly, sure that many people are interested in. That is also giving a shooting star candle this week for the end of the week, sitting right below its 21. So it's kind of hanging in there. It's trying to hang in there. But if you notice over here on the daily, it couldn't stay above the 200. Now it can't stay above the 50 or the 21 or the 5. And it has a shooting star candle on the daily as well. So now it's got a lower high. So this one might continue to go lower. If you remember what I did on Lilly, I did the same kind of thing where my strike price was 830, and you can see it's at today it closed at 822. So this one would have been a loss. Actually, I would own Lilly today as a result of this, but I got out of this on Monday when I first started seeing this roll over, and I made 35%, just getting out very quickly. I could have stayed in if I wanted to own Lilly. I would own it at a discount. I would have owned it at 830. I think it was 826. So still would have been a loss today because it's at 822, but not a big loss. I could have just sold it right then or wait for it to go up a little bit and sold it anyway. That's Lilly. Lemonade is on here. Meta is on here. This one just continues to go down. You can see the daily over here. You see what's happened now on the daily. This is what many charts look like as a result of this rally. They now are confirming a lower high. So these are all confirming a downtrend. MicroStrategy, because Bitcoin went down today, you can see MicroStrategy got killed as well. It's actually in a weekly squeeze over here, and it has a shooting star candle. So that's not looking good. Cloudflare, they all look very similar, don't they? Shooting star candle. This means that earlier in the week, it tried to make a rally, and the end of the week, it came down. Here's Roku, Shopify. You can just scan across from the weekly and take a look over here what the daily looks like. This is in a squeeze, and it's just firing to the downside. So this Shopify might continue. There's Snowflake. There's Toast. Twilio. There's a bearish engulfing candle on the weekly. Twilio, Wells Fargo, another financial. Looks like financials might set the tone for earnings in 2 weeks. So keep that in mind, especially if we do rally next week. And then communication services, a couple of sectors on here. That's an engulfing candle, communication services. Here's real estate, spinning top, indecision, and healthcare. Healthcare has not quite a engulfing, but looks like it wants to head lower as well. All right, not good news. Those are the scans for today. If we look at the VIX for today, it won't look good either. Where's my VIX? Come on, VIX, where are you? Here we go. Here's the VIX. So you can see it now is back above the 20 area and significantly so. So now the market is really looking volatile. The market is getting scared now. So especially since it stayed above 17. If it continues to stay above 17, even though it's in this neutral zone, but staying above 17 confirms the bear market. So if it continues to do that, then the market will continue to go down. And then finally, let's look at the bottom finder, look at the NDX, NASDAQ 100 first. And what you can see here, make this a little bigger. You can see we're sitting right on just about on support on the price. But look at the move that the percentage of stocks above the 20-day has made, all the way down to 25% now. So this is heading down to that 10% level rapidly. And it could get there, easily could get there next week. Percentage above the 50-day, that's at 31%. When this gets down to 10 and this gets down to 20, I'm going to show you how we can find the strongest stocks. The 10 stocks here that are still above their 20. And the 20 stocks here that are still above their 50, or it could be less than that even. And the 200 percent above the 200 is 44. That one, my line on this is at 30, and it's not even on the chart, so you don't see the line. So this one is at 44, meaning 44 stocks. So up here, only 25 stocks out of 100 are above their 20-day moving average. You can see the VIX moving up down here. I mean, all of this is telling the same story, same narrative. The market is continuing to go down, probably will, I think, for the foreseeable future. And what we have not seen yet for a bottom is more bearishness. We haven't seen that capitulation yet. We haven't seen people really just giving up and starting to move into puts, buying more puts. The put call ratio, this is the 5-day moving average of the put call ratio. So it's a 5-day average. In order for it to get way up here, it's going to take some movement. It's going to take a lot more selling for it to get up here where we usually see bottoms. So as I said, and I've been saying for a few weeks now, I said that we're probably going down well before we started, way back in here. I said that, and I said we probably will rally at some point, which we did. I thought it might rally a little higher than that, but went right to the 200-day. And I said when we get rejected, wherever the rally is, it will likely go down lower than the previous low. So we might be headed here to 18.5, and on the S&P is probably, let me draw this line in here. Sorry, I'm going long tonight, but the market sold off a lot today. So I hope that people are interested in why that's happening. So here's roughly where support is, right down there. Right down, I'll put it right there. So that is at 5,400. So 5,400 might be the next level that we get to. And then if we go below that, we could be headed down here to 5,150 is the next one. So that's possible. That's very possible. But the next level to be watching is 5,400 right down in here. All right, that's it for tonight. Sorry for not more good news, but there are ways to make money in this market. As in fact, if it continues to go down, like I just showed you with the let me actually show you again, and I'll show you some more. On the right here on the monthly chart on the portfolios page, this is the total market index. but I've also got the S&P in here. So you can see it's right below. This is a 13-day moving average. This is a 13 month. This is a monthly chart. So this is a 13-month moving average. So, last time we had the histogram below zero, that's where these arrows are. And you can see this was almost the whole year of 22. This one here was very quick because it was COVID, but this has been very consistent. So that's what the S&P looks like right now. Here's what the NASDAQ looks like. It's already below the 13. Here's what the Russell 2000, well below. It's actually sitting now on the 50, way down here. So all of these are, and you can see it's just started. You compare it to back here when the moving average lines, the MACD crossed. It's just beginning. So we've got a lot more downside ahead of us. That's where it crossed there. We're just now crossing. All right. Sorry if you think this is bad news, but those that know how to short might think this is good news. So because the market goes down a lot faster than it goes up. So good luck. Stay safe. Have a great weekend. And I will talk to you again on Monday. Take care, everyone.